Hey, welcome everyone. Welcome to our webinar, probably one of the final few of the year because believe it or not, 3 weeks from today, it is New Year's Eve. So 2024 is that close to being in the can. My name's Ted Steinkamp and I am part of the sales team here at Advanta IRA. I'll be showing you this slide a little bit later on the presentation, but feel free to reach out to me if you have any questions about what we discussed today. Today I'm going to be presenting Josh Friedensohn with Greenleaf Management. He'll be our speaker for today. Very engaging material. As I've always promised everyone, I would only bring on a speaker if it's high value creation. And we have that with Josh. He'll be talking about some of the opportunities out there in the office space. As many of you know, it's been a very challenging year or a couple of years for office, but opportunities are emerging, and I'll have Josh talk about those very shortly. But just real quick, couple of quick housekeeping items. For today's webinar, please keep in mind Advanta IRA does not advise or endorse any investment products. We don't sell them. And we don't provide legal, tax, or financial advice. We certainly ask that you consult with your respective advisors. Today, questions will be answered, so please be sure to enter those in the chat box at the bottom. And at the end of the webinar, we'll go through a Q&A session with Josh, and we will get everything answered as they come in. But just a couple of quick things about Advanta IRA. As a company, we've been around over 20 years. We have over $3 billion in assets under administration, and that is spread out amongst over 13,000 unique account holders. Any and all cash that is held in the accounts outside of the investments, we stuff that into FDIC insured bank accounts with those respective institutions, and they're fully insured up to the applicable limits. And then, of course, everything here at Advanta IRA is all about personal service. That's why we have an account manager assigned for every relationship, and we have a very deep bench of colleagues that assist. A couple of things too, we're also all about education. We believe in opening up our forum not only to guest speakers, but also to account holders and those interested in what we do here at Advanta IRA. So whether you're interested in our events, the podcasts, the blogs, all of that can be found on our website. We'll talk a little bit about that later. One question we are always asked when I mention I'm with Advanta IRA, a lot of people will ask, what is a self-directed IRA? Well, very simply, it's no different than any other IRA. They've been around since IRAs were created back in the mid-70s, but what it allows you to do simply is to hold alternative investments. Many of you are familiar with marketable securities, annuities, the products that most financial service providers sell. We don't sell the products, we allow you to exercise your creativity. So you can hold certain physical investments like real estate, cryptocurrency, precious metals, etc., all in a self-directed IRA. That's the business we're in, that is our business model. Now, what you do obtain when you do a self-directed IRA, one thing is complete control of all of your investment options and the investment decisions. You're not limited to any menu or any product that we sell because we don't sell the products. You get to exercise your creativity. Also, too, this is a great way to diversify your portfolio holdings and also to further enhance your wealth building capabilities for retirement or whatever the goal is for your IRA. I mentioned too, the alternative assets, when you look at the bullet points, you just go down the list. Yes, what you see on there are the most common, particularly with real estate, mortgages, private placements, etc. But I will say some of the creativity is phenomenal. We see people inquire about investing in car dealerships, construction waste dumpsters, washer and dryer units for rent. I mean, it is phenomenal. Now, if you ask the simple question, why have you heard about this before? Well, I did mention self-directed IRAs have been around since the mid-70s when federal legislation created IRAs in general. Only about 4% of IRAs are self-directed. what we're seeing for data out there in the industry, that percentage just incrementally creeps up every year, small, but it continues to creep up as more investors learn about the existence of self-directed IRAs. And as I said, the dominant players in the industry are really banks, brokerage firms, and to a lesser extent, insurance companies. They don't do self-directed IRAs like Advanta IRA does, quite simply, not their business model, and they simply just don't want to be involved in it. But the IRS really has only two limitations of what you can invest in or cannot invest in for IRAs. And those two limitations are no insurance contracts, no collectibles. Outside of that, your creativity is endless. Now, why would someone want to pursue directing or self-directing their IRA account? Well, first of all, for a lot of people, this is a very tangible source of capital. And it's also separated and aside from their own personal savings. Maybe the cash you keep in the bank, you're going to use for your emergency fund in the event you may lose a job. Maybe you have children in school, tuition payments. Those of us with kids know that pain every semester. Or maybe you just have other desires and needs on how you want to use your cash. Also, too, stock market, a lot of people get tired of it. It's very commoditized, mutual funds, ETFs, stocks, bonds. None of it's quite exciting, but the creativity here on the self-directed IRA side is. And of course, tax benefits. None of us like paying taxes. I certainly don't. But if you could have all of the returns directed into the IRA or to be paid there, and have them handled in a tax deferred or perhaps a tax-free manner if it's a Roth IRA, that's another huge benefit. As I mentioned a little bit earlier, if you want to learn more about the benefits, go to our learning center on the AdvantaIRA.com website. We have all of the content posted there, lots of educational and informative material. For just 3 quick takeaway points from here before I come in and introduce Josh formally. Keep in mind, any account that has the letters IRA after it, you can self-direct, and also old former employer retirement plans. You get to choose the investments, all of the expenses are paid by the IRA, and all of the income is received by the IRA, and it's tax deferred or tax-free, depending upon the IRA format. And if you do want to get started, you can simply go to the website, open an account, fund it, and then we'll help you get it placed into the desired investment of your choice. So with that being said, what I would like to do is bring on our presenter, Josh Friedensohn. He is with Greenleaf Management. Josh, I'm going to bring you on.
All right, thanks, Ted. I appreciate that. And thanks for the background and about self-directed IRAs. We've been working with self-directed IRAs with our investors for probably the better part of 15 years. We have a total of about right around 484 investors, and roughly about 100 of them are using self-directed IRAs in some format. So it's a very common and comfortable space that we've been involved in for a while, and I think Advanta provides an excellent service to allow that to happen. So as Ted said, my name is Josh Friedensohn. I live in Peachtree Corners. I started dating my wife when we were 12 years old. We have 4 boys, age range 4, 5, 9, and 11. We have a lot of fun together, all boys. We started, my business partner and I, his name is Dave Codray. We started the business in 2008. Our anniversary is December 15th, so it's coming up in a couple days. And we've been really just buying distressed opportunities since we started. And we really started out buying some single family homes during the 2008 great financial crisis. The results of that really hurt the single family home market. We moved into some student housing in the distressed sense of it. And then we started buying apartments, and that's really where we had our first big run. We bought about 4,000 apartment units in about 5 years, really from 2011 to about 2016, 2017. And I've been operating that portfolio really since. Once like 2019, 2020 hit, we felt like we were getting priced out of the apartment market, and decided to start selling. And we sold about 2/3, maybe 3/4 of that portfolio, moved into some mobile home parks, bought some office buildings, bought some industrial buildings, bought some retail. So it really helped kind of expand our portfolio quite a bit. But again, the same sense of it, which was buying opportunity and buying where other people might not be buying. So we bought 25 mobile home parks between 2018 and 2020, when others were not buying mobile home parks. So we learned a ton. We built a nice portfolio. We made a lot of money on most of those parks. We still have a good amount of those parks as well that we still operate. One clear distinction with Greenleaf and our business compared to other groups that do what we do, there's a lot of groups like us. I think there's estimated to be about 3,000 groups across the country that pool together investor capital and buy commercial real estate. One thing that we stand apart is we're vertically integrated, so we operate everything that we own. We have maintenance staff, leasing staff, property management, capital improvements, that kind of stuff. And really it was by necessity. We're usually buying where other people aren't. So when we started buying apartments, we were buying 40 and 60 and 80 unit and 100 unit deals, when the operational model is more in the 2 to 250 unit range. And the same thing in office buildings, our sweet spot is buying 50 to 200,000 square feet, where the traditional property management model is north of that in terms of scale of the business. So what we generally do is buy a lot in really concentrated areas. So we really only buy in the Southeast, predominantly from Atlanta to Charlotte along 85 is the majority of our assets. We have a good amount in Chattanooga as well along 75. But if you come to like the Norcross area, we can take you on like a 15, maybe 20-minute drive around and go buy 10 properties that we own that are on different sites. So we generally target a specific location and buy as much density as we can. So that's some background on us and how we do it. Lisa's on the call too. I'll introduce her kind of towards the end. She runs our investor relations team, but that's some background on me and the company. I'm gonna dive right in. If there's questions, put them in the chat, and Ted can stop me anytime. I'm happy to be interrupted throughout if we need to slow down on any of the topics. I talk about the deals frequently, so I'm pretty comfortable with them. So if I fly by something that you guys want to spend some more time on, let me know. And here we go. So you should be seeing my screen right now, which is a single-story office building. So office has, really since COVID, so give or take 3 years now, has really been a bad word in the commercial market. Most lenders are terrified of it and have too much of it on their books. Most investors have too much exposure to it already, and most sponsors are licking their wounds on what do they do with their assets. From our standpoint, the buildings that we have, and we have about 2.5 million square feet of office buildings. So good amount of exposure. The buildings that we had, I would say pre-COVID, had long-term leases and were, for the most part, fully occupied. The buildings that we bought since is we're targeting buildings between 30 and 50% occupancy. We would buy as high as 80%, but generally speaking, our sweet spot is about 50% occupancy. And we really like suburban Atlanta, single-story office. So let me double down on that. It's suburban Atlanta, so not downtown, not perimeter center, not Buckhead, the suburbs. So you're talking about Marietta, Norcross, Alpharetta, Cumming, Kennesaw. These are the areas that we love, kind of in that northern part of the kind of the Atlanta triangle. And single story is really the key word. What we love about single story is it provides us a lot of flexibility of use. So if you go to the Bank of America Tower downtown, you really only have one user for that type of building, which is a professional services type of user that's looking for a very traditional office that's fully built out office. If you go to a single story office building, we're actually buying a lot of old call centers. So a lot of call centers are being offshored or being replaced with AI. And I think the last couple of buildings we bought, one tenant would be 40, 50, 60,000 square feet with 200-300 cubicles in it, just jammed in there. And what we're going in is just throwing all that away. We're turning 70% of it into kind of storage and warehouse, and 30% of it into office. The other thing we're doing is we're breaking up into small tenants. So our sweet spot is leasing to 3,000 to 7,000 square foot tenant. So that's a more of a mom and pop company that has a lot of flexibility of use, that has a lot of, I would say, free range to move. So you're talking with the decision maker. You don't like if you're signing a lease with a Fortune 50 company, right? There's layers and layers of decision makers in that lease. When I'm talking to Joe Schmo HVAC company that needs 4,000 square feet, I'm talking to Joe, and we're signing a lease with Joe. We have an in-house leasing team that works directly with brokers. So we do not do the leasing ourselves in-house, but we have a team in-house to make brokers' life easier, make their decisions faster, make sure they have what they need, and also make sure our tenants are happier. So that team is 3 or 4 people, and for our 700 tenants. And their primary focus is renewals. So our general philosophy is the day that a lease is signed, we have to start working on that renewal in 3 to 5 to 7 years from now. And how do we cater to that customer to attain that renewal? So that's what the in-house leasing team is. The third-party leasing team that we work with does all of our vacant spots. So I'm going to dive into this deal. This deal is, let me move my screen around here a hair. See if I minimize this. All right, so this is a single-story office building in Milton, which is a suburb of Atlanta. I'm going to scroll to the next slide so you guys can see some of the metrics here. Milton is a suburb of Atlanta, kind of north of Roswell, west of Alpharetta, and east of Marietta. It's right along 400, so super easy access. And Milton, if you walk into their city hall, Milton, it says Milton is a rural town, and we intend to keep it that way. So what we love about Milton is, and we've met with the mayor, we've met with the city council, we're very excited about doing business in Milton because they are very protective of their city and their model, and they're not looking for new entrants. So there's very little office, there's very little multifamily, there's very little commercial product. I believe the number is 97% single family residential for the city of Milton. So if you look at the existing buildings, like the little bit of office that's there is in very, very high demand to service all the single family residential. So we bought this problem asset out of one of the big REITs in Atlanta. It was a problem asset because they had 3 large tenants that were between 20 and 40,000 square feet that left over a multi-year period, and they didn't want to pay the improvements to release the property. So they really just let the property sit vacant. And our sweet spot is when we're buying a property, we're looking to come in 3rd or 4th place. We're not looking to ever come in 1st place. So last August, we put our bid in at roughly $10.5 million. We end up paying $10,875, as you can see on the slide. We put our bid in for $10.5 million, and they chose someone else at $14 million. That buyer fell apart. So fast forward 2 months later, they chose someone else for $13 million. That buyer fell apart. Now they're getting exhausted. Again, this started in August. It's around first of the year, 2024. And they came back to us, hey, listen, if you can hit 12, we can make a deal. We're like, no, listen, our number was 10.5. That's it. That's all we're willing to do. So they went with another group at 12. That guy fell apart. So they finally came back to us. We agreed to go up a little bit at $10,875, $64 a foot, and buy the property. We end up closing it in August, just about on its year anniversary from the day that we put our first offer in. That's really common for the deals we do. So we have an acquisitions team that keeps a really robust pipeline for us because our deals take a very long time to actually come to fruition. From the day that we first hear about a deal, the minimum time that it takes to close is 6 months, because it takes that long for the buyer or the seller and us to get on the same page. It doesn't take that long to actually close it once we have an agreement. It just takes a long time for them to capitulate to our price. So as you can see, the property is, I don't know if you can see my mouse or not, but you can see the property is 23% occupied. The average WALT, this is weighted average lease term. So the average lease that's on the property has 3 years left on it. And there's only 3 tenants. This is perfect for us. We're buying it super cheap, $64 a foot. There's a little bit of occupancy that tells a story, but not enough occupancy that we don't have the flexibility to do what we want to do. So we like this story a lot, and we're going to take the remaining 140,000 square feet, and we're going to break it down into 3,000 to 7,000 square foot units. And that's going to push the higher end of the market on leases. So if the current leases are, say, $10 a square foot, we think in smaller suites, we can get $12 or $13 a square foot. And we bought this, again, we closed in August. So in August, that was just a couple months ago, we're really just getting rolling on this. So we're starting our construction, our releasing brokers are already engaged. They know what we have, but they also know that suites aren't necessarily ready yet. But if someone comes by and says, hey, I'll take a building as is, we're always happy to work with them. For example, a month after we closed, we had 2 hurricanes hit the Southeast, and FEMA needed a central headquarters that was between North Carolina, coastal Georgia, and North Florida. And so they came and leased 30,000 square feet from us within our first month. They took the property as is. They needed to move in immediately. What that does for us is it gives us immediate income. It's a short-term lease. They only signed a 1-year lease with us. And so it just really buys us time and gives us extra revenue. I believe we're going to be getting about an extra $700,000 of revenue that we did not plan on from this short-term lease. So we'll just renovate the other buildings and come back to this building on the back end. In the meantime, we made an extra 700 grand that we did not plan on, which was awesome. So we're very excited about the building, showing early potential as well. By the way, this is the third property we've bought similar to this in the last 18 months, totaling about 600,000 square feet in total. So what we do is we search the market for opportunity, we find that opportunity, and we aggressively go after that opportunity. We put a bid out on 1 to 2 deals like this every single week. And again, it takes a while to get terms, so we keep a really robust pipeline. This is a really standard deck from us, so I'm going to fly through some of the slides. Happy to email it to anyone that wants to see it and dig in more. This slide is fairly basic. It just really gives you an overview of the location and what's around it. And all those little pinpoints all over the slide, those are other properties that Greenleaf owns. So you see it's very much in our operating footprint. And by the way, this is a zoom in of the Atlanta area. So even though from left to right, you're talking about from the left edge to the right edge, you're talking about like a 45-minute drive across the city. So the center out is like a 20-minute drive. So this is not a very big area that we're zoomed into on this map. This is showing you the neighborhood, the immediate location. So if you can see my mouse, I'm pointing to this upper right-hand picture. The dark green is the property. It's 3 buildings, 2 L-shaped buildings and 1 straight building. The rendering to the left that's blown up just below it is a city park that the city of Milton is buying the land for, and they're developing adjacent to our property. We have an agreement with them to create an entrance and a driveway from our property into their property. So it's just a great partnership that we're working with the city on to give our future tenants multi-use and multi-access to walking trails and other things. There will likely be a revenue stream in the future that once this park is open, the city has already told us that they'll need overflow parking on the weekends and they'll want to rent parking spaces from our property. Fantastic. So we call this flex office. So that's where you'll see the term flex come in here. We're calling this hub flex. And this is this concept that there's a flexible user, meaning that there's some warehouse component and there's some office component. So it allows a tenant to be really flexible that like, hey, I need a little bit of storage. We have some people that have 10% storage and we have some people that have 90% storage. It's just, we're willing to build it out really however. And this shows you all the flex properties that we bought throughout Atlanta really over the last 3-ish years. And then the rents that we're getting compared to the rents that we're projecting on this property. We're modeling $13 a square foot. You can see we've really gotten anywhere from 12 up to mid 14s on lease rates. This is the current rent roll. Again, not super exciting. There's only, 15,000, but like 40,000 square feet of 170 occupied. Not much to really brag about, like other than we have a lot of vacancy to work through. It'll take us about 2 years to renovate and lease up the space. So you see that, and so one distinction that whether you're looking at one of our deals or someone else's, when you're looking at office deals, the structure of the lease is very distinct. For example, FSG means full service gross. This is a term that means that all operational costs of the suite is paid for by the landlord. So if you look at Encompass Health, paying $23.69, that's quite a bit more than what I told you we would be targeting. And that's because we pay all the operational costs, including electricity. Versus if you look at the vacant suites, we put 13 triple net. The triple net is all those operational costs being billed back to the tenant. So at the end of the day, 13 compared to 23 full service is actually fairly comparable. The biggest difference in triple net is that the tenant will eat the inflationary impact of operating cost of the property, versus when it's full service, the landlord eats the inflationary cost. So our goal as a landlord is to convert all of our leases to triple net to protect us as the owner from inflationary runaway, and let that be on the tenant. We can talk for an hour about full service for a triple net, but that's your really high level explanation. This is a slide that we don't have to dig into too much, but it just really shows lease comps in the area. You see they range from $13.50 to $15. We went lower. We generally like to be on the lower end in the more affordable range to lease faster. So what we'll end up doing is lease at, say, 13 to get most of the property leased, and then maybe the last 20% we'll start increasing our rates at 13.50, 14, maybe we can get close to 15 depending on demand. But we want to start softer so we can lease faster, because every day that property is down is costing us lots and lots and lots of money. The float on this property, I think, is give or take about $75,000 a month. So we need to get leased fast. We have the reserves for that, so it's not like that's a surprise to us. It's more that every day is worth quite a bit of money. Looking at $2,000 to $3,000 a day. That every day that takes longer for us to get leased, we're spending that. These are sales comps. So I'm going to give you the kind of the high level story here. So we're buying Hub for $64 a foot. I'll scroll down here in a minute to tell you more about the improvements, but we're going to put about $30 a square foot of improvements into it. So our overall base is going to be, let's just say, $95 a square foot. You can round with some operational burn and all that. Let's just round it to $100 a square foot. As you see in all the rest of the comps range from 130 to 160. So that's basically our stabilized value is in that range. So we believe that stabilized value is in that 160 range. But even if we're off and say it's only 140, it's still a really good deal for us because we're only into it for 100. So the reason why we like these properties, buying them distressed, is because we can buy them cheap, put a lot of money into making it basically a newer product, and then still have a nice spread on the exit value. This is why we think office is a good word, not a bad word. We're pretty excited about it. This is the overall capital stack. I'm going to fly through this. Buying for 10,875, putting about 5.5 of improvements in. We'll spend about $800,000 on closing. Yes, that's a lot of money, but on larger properties, closing costs are like, for example, the lender gets a 1% fee. So our loan I think our loan on this is $12 million, give or take. Here's the loan, 13,874. So our lender fee is $138,000. So you see how that adds up. We'll have $2 million of reserves. With FEMA leasing from us earlier than planned, we're going to be able to shave off that revenue. So we should pick up an extra $700,000 of reserves that we didn't need, that hopefully we'll be able to do a return of capital once the project is complete to investors, because we didn't have to spend that money. So our total deal here is about $19.2 million. I'm going to jump down to our structure. We'll get about 13.8 in debt and raise the rest of that money in equity. I'm moving some screens around so I can see the next part. Our structure with investors is a 7% pref rate or hurdle rate. And then over that, it's really simple. We split 70% to an investor, 30% to Greenleaf as profit sharing. We charge a 2% acquisition fee. Again, that goes into the closing cost. And then on the right-hand side of the screen, this shows you what day one revenues and expenses are, and what year 5 what we're projecting revenues and expenses to be. And you see, we're not going to make a whole lot of money. We're going to lose $1 million in our first year. And then year 5, we're expecting that we're going to make about $815,000 net cash flow, which should return about 15% to investors And if you include principal pay down on the loan, that's closer to 20% annualized returns. You see the vast majority of the improvements are on tenant improvements. So the money that we're spending on the actual space. The next biggest number is leasing commissions. Our leasing brokers make about 6% of all the space they lease. That's what the market is. You pay what the market is. The rest is fairly nominal for just really HVACs, roof, parking lot, that kind of stuff. We have some miscellaneous costs. I know we're removing we're spending about 150 grand on removing trees that are overgrown on the property. This is a very, very dense slide that shows you the P&L of the property. The couple of things I wanted to point out here is current revenue is $3 a square foot. Our goal is to get it to $18.50 a square foot in year 3, and ultimately $19.92 in year 5. So you see kind of year 1 and year 2 are fairly light. Year 3, this builds up pretty quick. Our operating expenses, again, we normalize everything to a square foot. It's the easiest thing to talk about. We start with about $5. It kind of increases as inflation kicks in. We have interest-only loan for the first 2 years, so you'll see no principal payments, and then principal kicks in. And then you'll see in the first 3 years, we have no reserves for tenant improvements and leasing commissions. So we only have reserves for exterior improvements. And then year 4, we'll start reserving towards tenant improvements and leasing commissions, planning for potential rollover or incentives to keep people staying at the property. So typically on a property like this, we would offer 1 month per year of rent. So if they're signing a 3-year lease with us, we would offer 3 months free rent. Additionally, it's usually around $1 a square foot. These properties are not like traditional office buildings. They're more like industrial buildings. We're going to offer a very low amount of TI because we're going to build them out. We call it white boxing. We build them out as a standard platform, and for the most part, the tenants take them as is. This is the last slide. This shows you really a 5-year cash flow, what investors can expect, including an exit, and a sensitivity table at the very bottom here, showing that we're targeting a 7.5 cap exit. If the cap rate's higher, it'll have lower returns. If the cap rate's lower, it'll have higher returns. We don't put a whole lot of weight in IRR or equity multiple or exit valuations at all. Frankly, it's a made-up number. Our focus is cash flow and how do we get to cash flow and how we pay distributions. And our opinion, our general philosophy of business is if that all goes well, we'll be able to exit for a nice return. But for me to pick an exit value today that's going to happen in 5 years is kind of irrelevant. So we don't spend a whole lot of time talking about IRR or equity multiple. It's more what kind of cash on cash returns can you expect while investing in this deal. And with that said, that's the presentation. So Ted, I'm good for questions or any other things we want to discuss. And if there's nothing else, I can hand things over to Lisa, but
yeah,
that's the story.
Great. And I have a question for you, Josh, while I'm waiting for a couple to come on in here. You and I were talking, God, probably 6-8 weeks ago about replacement cost in the Atlanta market and really all around the country. If you had to replace this structure, what are you looking at for construction costs in square footage terms?
Yeah, so the quotes that we're not new construction guys. We're normally retrofitting that exists. But the guys that I know that do build this type of product are looking at $180 to $220 per square foot plus land cost. So I think you'd be looking somewhere in the neighborhood of like $270 to $280 a square foot. Okay. And that's highly variable based on the interior office build out. So for basic office build out, I think that's fair. If you're going to do a more technical office build out or a high end office build out, I think you're looking at closer to $400 a square foot. You can throw an extra $100 on there.
Okay, and that's going to be for very high end office space, correct? Literally state of the art.
Yeah, where we've seen slippage on properties like this is like we have another property like this in Tucker, Georgia. And we had a doctor group come to us, and they wanted to do a heavy medical build out for cryogenics. and we gave them, I think, $20 a square foot, and they're putting an additional $150 a square foot into it on their dollar.
So that's pretty substantial.
Yes. But in terms of just getting the structure and the land, I think you're looking give or take $250 a square foot.
Okay. Now, question regarding pivot points. Every deal we always want to see go well. As an investor, you always want to know what are the pivot points if things go sideways or go downward. Can you kind of elaborate a little bit on that?
No, it's a really good point. So what I like about this type of product, so we have a lot of different offices. We have, I think our tallest building is 6 stories, and we have a lot of single story. The building I'm in right now is a 2-story exterior walk-up. What I like about the exterior entrances, the single story nature, and the kind of big parking lots is that worst case, you can just demo the whole thing and put something new and nicer on it, assuming it's a good location. For example, the building that I'm in right now, we're working with our neighbor to demo it and put multifamily, retail, and a hotel on it. So that's kind of like your ultimate, like, okay, if things are really not working, what can we do here? In terms of what else can we do with a product type like this, you can always do more office, you can always do more warehouse. We are careful to zoom in on zoning to see what types of uses are allowed or not allowed. For example, a liquor store is allowed at this property, the one I just shared with you, but a liquor drive-through is not. Restaurants are allowed at this property, but drive-throughs are not. Mechanical automotive parts and sales are allowed, but you can't do oil changes at the property. So these are just examples of 100 different zoning codes that govern a property that allow you to do or not do something. So when we looked at this property in terms of pivoting, we're like, okay, it's restrictive commercial land in Milton. That's valuable. It could be used as office or more industrial flex. That's valuable. It's also zoned self-storage. That's valuable. And it's also zoned restaurants. That's valuable. So this gives us a lot. I think to answer your question, like the short answer is, what's the zoning code say? And what does the zoning code allow us to do? If you don't like it, what is your plan to rezone? And we've rezoned properties too just fine. So Milton was very clear, you're not allowed to rezone this property and we will not approve any alternative uses. So then we really studied the zoning code and got comfortable with it. And those are some of the examples that I shared honestly, it was really close to 100 samples of what's allowable or not allowable in the zoning code for this specific T6 zoning.
And I know we've been talking a lot in this presentation about the Atlanta market. Certainly, I want to keep things on the educational track here. But do you foresee this sort of platform that you're pursuing right now, or these opportunities, as being something you could pursue nationally?
Absolutely, yes. I don't know too many groups. I know other groups that are buying office buildings. I just don't know many that are buying the single story. I'm good friends and we invest with a group out of San Antonio, and they've bought a lot of it, and we invest in all their deals. They buy between San Antonio and Dallas and Houston. They do a fantastic job. If anyone ever wants a referral to them, we're happy to connect you because we're good colleagues with each other. But they're really the only other group that I know that's aggressively doing this.
And just what you're seeing out there in the marketplace. I want to bring in the informational aspect. What are you seeing nationally and even regionally here in the Southeast for vacancy rates and perhaps even future opportunities to pounce on new properties that kind of fit the matrix of what you're trying to achieve?
So my favorite quote that I've read recently from a CoStar report is that office vacancy is at an all-time high, and office rents are also at an all-time high. So think about that for a second, right? Vacancy is at an all-time high, meaning that the properties are the lowest level of occupancy they ever have been, which naturally you would say, why don't you lower rents to get them occupied? But in reality, what's happening is that office rents are also at an all-time high. So what that tells me is that you have a lot of defunct office property on the market, meaning from a lease standpoint. You have a lot of defunct office property that's on the market for lease that people are just not willing to lease. That they rather pay up and lease nicer property or property that's more purposely built out than something that was built in the 80s and hasn't been touched since then. So that anecdotally, that's one of my favorite, I would say, nuances of this wacky market that we're in right now. And we're seeing it as well, that in our office portfolio, we are well over 90% leased and occupied in over 2.5 million square feet. Basically, if the office is move-in ready and recently modernized, meaning that paint, flooring, and there's nothing kind of out of whack, it's leasing immediately. We have a property with 80 tenants in it in Marietta. It's about 130,000 square feet. It's 97% leased. We had to lease a broom closet a couple weeks ago. So the office demand in suburban office is going very, very well.
Great. For all the listeners and viewers out there, if you'll please type in any more questions you may have. I do have someone, Josh, that did ask if we could please get a recording and a copy of the slides out to them. So sure. I'll certainly coordinate with that with you after the presentation later today. And if anyone has any questions, please enter them now because we're getting toward the end of the broadcast.
And this would be a good time for me to introduce Lisa. Lisa runs our investor relations, and she can tell you more about how to get involved with us.
Yeah, of course. Thank you, Josh, and thank you, Ted. I'm Lisa in Investor Relations. So if you have any questions after this, we can happily provide this slide or any other slides on Greenleaf. As Josh said, we have multiple flex properties. And one of the things I don't think that he really got into much, which is interesting, is the roller doors of our flex space, which is it's always sexy to investors, being able to install those roller doors in the back. Another thing that we have, if you want to, you can drop your email in the chat. I won't be able to see it, but Ted will provide it. I'd love to be able to sign you up for our communications. We don't send out a lot of emails, but you would be able to see any new deals we have. In addition to our industrial flex deals, we're also doing debt deals, retail, everything. I'm launching one this week. So if you're interested in seeing more from us, please send us your email, and I'll also send you for some free swag. And of course, if you need to reach out to me, you can always reach out to me at invest@greenleafmgmt.com. Thank you.
Great. Josh, quick question that just popped up. Is minimum investment that Greenleafs will accept from an LP investor? Might you be able to talk just a little bit about that?
Yeah, so our general philosophy is we like, we don't allow anyone to have more than 20% of any deal. We'd like to have a good mix of investors. We also like to keep control of the deal. And let's just say if we had one investor at 80% and then had a bunch of friends come in at 20%, the 80% guy is actually running the deal. We are not. So we like to keep it a mix of smaller investment amounts. The minimum investment is 25,000. People generally invest between 25,000 and 250,000, depending on the deal size. We'd love to have you get to know our business more. And what would happen from this call, if you're interested in getting to know us more, Lisa would be connected with you. She'd set up a call kind of one-on-one with myself and you. We get to know each other, kind of talk about business philosophy, make sure we're all on the same page about how we operate and how we do business. And then we can talk about connecting into a specific deal.
Yes. And also, if you want to learn more about us in the meantime, before you're ready to set up that call, we do have a YouTube channel, and we just debuted a really great new series. It's called Dave's Drive-By. Dave is the other partner, as Josh mentioned, and they go around and they try to find out what makes a good deal. So they'll visit lots of local properties. They can say, why is this a good deal? Why is it not? I think that's a very educational and a good start too, if you're not ready to set up a meeting yet. But of course, if you do want to set up a meeting, we'd love to hear from you.
Josh had a question come in from one gentleman. He's asking, he says, I know this is not your business model, but do you have any ideas for older multi-story buildings?
So, and we have a handful of those buildings. We probably have if not a dozen, at least 8 multi-story office buildings. I think they have to be modernized, they have to be updated, they have to be well built out, and frankly, we do the most leasing with smaller tenants, so they need to be subdivided to be smaller suites. So I'll give you an example. We have a 6-story building in downtown Chattanooga that's in the opportunity zone. We did an opportunity zone fund a couple years ago, and it's in that fund. Each floor plate's about 8,800 square feet at 6 stories. We've renovated the building really well. It's a beautiful historic building built right around turn of the 20th century. So, you know, call it a 130-year-old building, give or take. And I would say we left it open-ended to show the market and say, hey, historic hardwood, vintage hardwood floors, big open windows, tall ceilings, come see this beautiful property. And it is beautiful. And we did a bunch of tours, and people looked at us, shrugged their shoulders, and say, what do I do now? I don't know where my office is going to go. I don't know where my employees are going to sit. I don't get it. So we lost about a year of leasing to that. Then we decided, you know what, we need to show the market what they could do. So we took one of the floors and we built it out. We divided it in half. So it's roughly, give or take, 4,000 square feet of leasable space. And divided in half and call it like 6 to 8 offices and a conference room. It leased overnight, like immediately, because it was brand new, it was purpose built, and it was move-in ready. So that's where we have found the most luck. We have other buildings in Chattanooga, and this is in downtown Chattanooga, by the way. We have other buildings in Chattanooga that are well divided, but they're not modernized. We're hesitant to spend a bunch of money before we have leases. And so we need a much more creative tenant to see that, and a more patient tenant. But at the same time, you know, our hesitation with it, and we've done this before, which is spend a whole bunch of money to do it wrong. And then a tenant comes in and says, do it again, but do it my way. So the short answer is don't go out too far over your skis, but you do need to have some show ready, move-in ready suites, but moderate that. I hope that answers the question.
And I did have another question. So we still have a few trickle-ins. One, Lisa, would you please repeat your email address?
Yeah, of course. It's invest@greenleaf, GREENLEAF, MGMT, as in management.com.
And that will go directly to your inbox, correct?
Yep, that goes directly to me, and we do monitor it. We have a really good investor relations team here. So, of course, anytime you want to get in touch, you can reach me there.
Okay. And Josh, I have another question for you. The question is, does Greenleaf JV with other groups in distressed office investments?
No, the short answer is no. We like to have control of the deal. We don't really do JVs. I would say the most of a JV that we're doing right now is we are issuing debt to other sponsors. So we are not coming in an equity position. We're not coming in a control position. We're purely issuing debt with, you know, with proper recourse and guarantees on it. But we don't really JV. It's just not our business model. We like to control the operations of things, and generally speaking, whoever the other side of the JV is they want to control it. Whoever found the deal wants to control it. And just historically, we've not found a partner that wants to work with us in the way that we want to work. So it's just not a good fit for us. But if there was a partner that wanted to kind of hand over controls, we'd be interested in talking to them.
Now, I do have someone, and Josh, I may take this offline with you. They do have a property, and I'll approach it directly about it. I just want to keep everything educational, informational here. Let me just do that. Any other questions from any of the attendees? Because we're coming up on the time limit here. Okay, I'm not seeing any others creep in. Josh, any other final comments you'd like to make, or Lisa, any comments you'd like to make to close out?
I guess my other comment is if you want to follow us on LinkedIn too, we do share all our deals there as well. So another resource, and of course, check out our YouTube as well. I do think there's a lot of great informational material on there.
Yeah,
Okay.
thank you, Ted, for allowing us on here, and we appreciate the time. We appreciate all the attendees joining us, and you know, if our if what you heard today and our philosophy of approaching business, bodes well with you. Always happy to talk. Always happy to discuss. It doesn't always have to be about investing with us. We're in the business of making friends and building community. So if it's interesting, you just want to talk, you just want to hear more about it or compare notes to whatever you do, we're happy to be a resource for that as well.
So with that being said, if anyone has no further questions, how about we bring it to the close? We'll all enjoy the final 3 weeks of the year, and happy holidays to everybody.